Are we on the brink of a financial disaster? Today, we delve into Lynette Zang's alarming insights regarding the dollar's plummeting purchasing power.
Absolutely. With over 4 decades in finance, Lynette presents an alarming forecast of hyperinflation expected by 2025.
This is vital. She reveals that the dollar's buying power has dwindled to a shocking 3 cents. What implications does this have for our economy?
Exactly. We'll also discuss the troubling trends in the banking sector, marked by numerous mergers this year, indicating potential instability.
What should investors brace for? Lynette stresses the critical need for sound money in these uncertain times.
Stay tuned. We've got key strategies to share, along with the importance of building community resilience as we move forward.
Welcome to Financial Insights in Minutes, your go-to source for timely financial analysis.
Our AI-enhanced summaries capture the essence of complex financial discussions. You're about to gain invaluable insights fast.
Afterward, we'll dive into interest rate dynamics and their implications for today's markets. Ready to explore the chaotic world of hyperinflation? Our next insightful summary covers Lynette Zang's shocking predictions on the dollar's purchasing power, which she believes is plummeting towards zero.
Indeed, Lynette, a seasoned economist with decades of experience, offers crucial insights into the impending collapse of the financial system and the threats posed by a rapidly devaluing dollar. Let's dive into the details.
What's at the heart of Lynette's message? What dire warnings does she have for us?
She confidently predicts that the dollar's purchasing power is rapidly deteriorating, forecasting a significant hyperinflation crisis by the year 2025. This deeply concerns her, as she believes we might regress to conditions reminiscent of feudal societies.
Let's dissect the key points. What's the current status of the dollar's value?
Lynette highlights a staggering statistic. Today's dollar's purchasing power has plummeted to just 3 cents. If this trend persists, we may soon witness a complete devaluation.
What about the stability within our banking institutions?
Lynette warns of distress in the banking sector, citing a staggering 54 mergers this year alone and a significant 20% drop in bank branches since 2009. They seem to be consolidating more than ever.
Now, let's further explore that hyperinflation discussion.
Hyperinflation, which officially indicates a price increase of at least 50% per month, is a terrifying prospect. Lynette anticipates that consumer prices will soar by 2025, raising serious concerns.
What's behind all this turmoil?
Lynette points to a growing crisis of confidence in the system. Public discontent has spurred a relentless rise in instances of unrest. Recorded civil disturbances globally have nearly doubled within a year.
Let's delve into predictions. What should we expect ahead?
Lynette argues that by 2025, hyperinflation will be a significant concern, with authorities escalating borrowing and money printing. It's a vicious cycle.
What about the future stability of our banks?
An impending banking crisis looms. Lynette warns that eroding public confidence could incite widespread panic and bank collapses. Central banks may push digital currencies as a possible solution.
So what's the most critical lesson we should take away?
Lynette emphasizes the necessity of fostering community strength and personal preparedness amidst looming economic shifts, urging all to take meaningful actions today to secure their future.
And what about Lynette's advocacy for sound money?
She pushes for a sound money revolution, urging people to stock up on gold and silver, representing a tangible way to secure wealth amidst chaotic monetary policies.
Let's jump right in. Today, we're examining the intriguing relationship between falling interest rates and stock market behavior.
Here's the scoop. Recent analyses reveal parallels between today's market dynamics and pre-recessionary signals observed in 2001 and 2008. But is the situation really that straightforward?
What's the core idea fueling this discussion?
The primary argument posits that both stock and bond yields are declining, indicating a potential recession. Yet previous examples point to market recoveries, raising questions about the future economic landscape.
Let's delve into the historical context illustrated in the analysis.
Indeed, in both 2001 and 2008, significant drops in stock prices coincided with declining bond yields, marking recessionary periods that investors fear may repeat today.
What does the current market scenario look like?
Today's environment is unprecedented. We are witnessing declining oil prices alongside a weaker dollar, three pivotal market forces moving downward. Such a combination is extremely rare.
How do these economic indicators impact the stock market?
A weaker dollar boosts S&P 500 revenues from international markets, while decreasing oil prices lower operational expenses, enhancing profit margins.
What could these trends potentially lead to?
Historically, the stock market rebounds following such conditions. Could we foresee a recovery on the horizon?
What predictions are circulating?
The expectation is for economic frailty. The market's current behavior signals alarm bells similar to those before the recessions of 2001 and 2008.
And how might this affect consumers?
Decreasing oil prices might spur consumer spending, compelling businesses to strategically adjust to changing circumstances.
To summarize, what key takeaways should we conclude with?
Navigating today's economic landscape necessitates understanding the intricate implications of falling interest rates, oil prices, and dollar value. Stay vigilant.
And what should investors keep in mind?
With shifting economic behaviors, staying informed and adaptable is crucial for weathering any potential market storms ahead.
Now it's time to explore China's economic outlook. What's the latest on their bond market?
Here's the scoop. China's economy faces headwinds evidenced by record low bond yields, indicating deeper deflationary risks. The market reactions might just reveal what's on the horizon.
What's the central theme in this discussion? Why do these declining bond yields matter?
The main focus is that record low bond yields are not merely numbers. They point to serious underlying economic issues, such as employment declines and ineffective government stimulus.
Let's break this down. What do record low yields signify?
Exactly. Rates currently at 2.06% reflect that investors are seeking safety amid fears concerning economic stability, rather than suggesting healthy growth prospects.
What's the status of employment in China? Are there significant trends?
Certainly. Entry-level wages are down by approximately 10%, combined with troubling unemployment figures indicating a potential crisis.
How is the government responding to this situation?
Generally speaking, stimulus efforts by Chinese authorities have been met with skepticism. Historically, they've failed to sustainably uplift the economy.
How does this situation compare to past economic crises?
The similarities are alarming. Current economic indicators bear a striking resemblance to signals from 2008, hinting at the possibility of a deeper crisis.
Given these circumstances, what forecasts can we expect?
There's a prevailing belief in prolonged economic decline. Continuing decreases in employment will likely further strain the economy, resulting in more government interventions.
What about market reactions?
An increase in market volatility is on the horizon. Investors are expected to adopt more risk-averse strategies, anticipating potential corrections.
What's the bottom line here?
Keeping a close watch is essential. China's economy is deeply entrenched in deflation, with little hope for revival without significant policy changes.
What should investors do now?
Investors must rethink strategies. With increasing instability, caution in investment decisions is paramount.
If this summary is helping you navigate these turbulent waters, consider subscribing.
Your engagement not only keeps you informed, but supports us in delivering valuable insights. Let's keep exploring together.
As we wrap, what's your forecast for China's economy?
We want to hear from you. Share your insights and predictions in the comments below.
Let's dive into today's discussion. We're exploring dire stock market fluctuations during the worst two-week span since 1950.
Let's get to the core facts. This report analyzes the Federal Reserve's decisions alongside remarkable market behaviors you won't want to overlook.
What's the primary theme here?
The essence revolves around alarming warnings of a historical downturn linked to uncertainties surrounding Federal Reserve interest rate cuts. How will this affect markets moving forward?
What historical context should we consider?
To provide perspective, September is historically known as the worst month for stocks. This year, it has also recorded its worst two-week performance, an alarming statistic.
How could the Federal Reserve's decisions influence the market?
Speculation surrounds whether the Federal Reserve will cut rates by 25 or 50 basis points. This uncertainty could incite increased market volatility.
What should traders focus on right now?
Maintaining an open mindset is vital. Current market conditions suggest potential rebounds, yet traders must remain prepared for erratic market swings over the upcoming weeks.
What predictions are surfacing?
Experts are forecasting heightened market volatility leading up to Federal Reserve meetings. Will we see familiar historical patterns reemerge?
Is there a glimmer of hope ahead?
Certainly. Despite current downturns, analysts anticipate opportunities for a bullish market surge, especially for those ready to invest wisely.
Let's wrap this up. What essential takeaways should we bear in mind?
Navigating these turbulent times requires a firm grasp of historical market trends and being alert to Federal Reserve actions that may impact investments. Stay vigilant.
Before we move on, let's hear from you. What actions will you take armed with this knowledge?
Drop your thoughts in the comments. How do you plan to navigate through this chaotic stock market?
In our next enlightening summary, we're exploring the intriguing landscape of precious metals with expert David Morgan.
Absolutely. Morgan discusses silver's potential to outperform gold, forecasting significant market shifts in just 3 years.
What foundational insights does David Morgan provide?
Morgan posits that as public awareness heightens around rising gold prices, many will pivot to silver, significantly driving both its demand and price, potentially surpassing gold's performance by as much as 4 times.
What recent trends in precious metals should we take note of?
Presently, silver is outperforming gold for the year, recording gains of 28% compared to gold's 25%. As gold approaches $3,200, more investors are likely to gravitate towards silver's affordability.
What's the psychological aspect surrounding the markets?
Morgan notes a shift in investor sentiment. As gold becomes less accessible, people flock to silver, driving its demand further. Moreover, silver's industrial applications, particularly in technology, contribute significantly to this increased demand.
How is the supply of silver behaving?
Interestingly, silver mining has plateaued, with numerous mines reporting declining yields. As demand rises, supply pressure could trigger a substantial price surge.
What pivotal predictions did Morgan put forward?
He anticipates that silver could exceed gold's performance, potentially by a factor of 4, as thirsty investors seek alternatives when gold prices escalate.
Are there any longer-term forecasts in play?
Indeed, Morgan hints at a monumental transition towards a new global monetary system, which could stoke further investment into hard assets like silver and gold.
Summarizing Morgan's insights, what key takeaways resonate with us?
Indeed, with mounting economic pressures, silver is poised to emerge as a primary investment, likely eclipsing gold. It's time to consider silver as a secure asset for the future.
What should investors be focusing on as they move forward?
Investors should watch silver closely. As dynamics shift, it may become the go-to investment, especially if economic conditions worsen.
What an insightful discussion we had about the state of our financial system.
Absolutely. Lynette Zang's concerns about the dollar's diminishing power resonated with many of our viewers.
And Michelle Makori's warnings about the banking sector mismanagement highlight urgent economic threats.
Meanwhile, David Morgan shone a light on the importance of precious metals as a safe haven investment.
It's clear that while there are common themes in the advice from our experts, there are also differing timeframes on when these risks will manifest.
Don't forget, dollar devaluation and hyperinflation are real threats, and understanding these dynamics is essential.
If you found this video helpful, please like and subscribe to our channel for more financial insights.
You don't want to miss our next episode, where we'll dive deeper into interest rate impacts on market stability.
Thanks for tuning in, and we'll see you next time.